The construction sector is reviving after COVID. On one hand, the government is increasing its expenditure on infrastructure to promote growth, and on the other hand, there is an increase in demand for high-end houses. Both these reasons are supporting the demand for cement companies. However, input costs have also increased for cement, due to which growth in profit is lower than growth in revenues. This strong demand has induced a rally in cement stocks in the last 1 month. The last 1 year has not been very good for cement companies, but the last 1 month has been very good.
ACC in Ambuja have been rising for a different reason. Recently, the Adani Group acquired ACC in Ambuja for $6.4 billion. With this acquisition, Adani has become the second biggest cement producer in the country. By 2030, Adani is looking to become the most efficient cement producer.
With the higher government capital expenditure and its measure for increasing the growth picking up pace, long-term average growth of this sector is expected to go up from 1.2 to 1.5 times of the GDP. Brokers are also expecting cement demand to shoot up in FY 22 to 25 as compared to FY 19 to 22. According to Jefferies, except South India, cement prices are going up in most parts of the country. Besides this, various brokers have changed their stance on the cement sector. Now the question is, why are brokers so bullish? Nirmal Bang has changed his stance on the cement sector from neutral to positive. Major players in the sector don't expect competition to increase in the short term. Rather, they believe that improvement in pricing coupled with lower operating expenses than before will improve profit margins. ACC and Ambuja utilize 80 to 85% of their capacity, and it is expected that huge increases in supply from these companies will take place after 2 to 3 years. So in the short term, high profitability in the sectors will remain. On the other hand, along with Ultratech, ACC and Ambuja has strong brand premiums. So these companies don't need to sacrifice pricing power for acquiring market share. In FY 23-25, major contribution to the capacity expansion will occur from prominent companies. The outlook for cement is also looking good. Demand is expected to improve after the monsoon. Realization of pent-up demand along with higher expenditure in the pre-election year, the total demand is set to improve. Higher demand may prompt cement companies to either increase the prices or retain the higher prices. Dual tailwind in the form of lower input costs due to the fall in coal as well as crude oil prices along with improvement in demand. Earnings result of companies are expected to show improvement. Analysts expect that by March 2023, EBITDA per ton can go up to 1,300 rupees.
That's not it. There are some other good indicators also. Results of cement companies are expected to improve in the second half of the financial year. Recently, pet coke prices have fallen by 40% while diesel, crude oil prices have also cooled down from their recent highs. Due to the decline in input costs, inventory management of companies is improving. Companies have shifted to pet coke from coal. This has increased the use of alternative fuel and green power, lower discounts per bag, or few such positive factors. But along with all this, we must also keep in mind that there are a lot of challenges in this sector. So the first thing is that the second quarter remained weak due to the monsoon. Strong monsoon in many parts of the country made it challenging for companies to retain higher prices.
Besides, the entry of the Adani Group will increase competition in the industry. One more challenge is that due to geopolitical uncertainties, coal prices are still 4 times higher than the low of April 2021. Recently, pet coke and coal prices have come down, but it needs to be seen whether prices will reach the lows of 2021 or not. Also, the benefit of lower input cost won't accrue before the third quarter until high-cost inventory is used. It needs to be kept in mind that power and fuel costs account for 30 to 35% of the total cost.
Now the question is, should you invest in cement companies or not? So the fact is that input cost of companies are falling, but that is already discounted in the price of shares. The price has not risen as much until now as much as they had fallen. So in the short term, there is no big change on a fundamental level in results and shares. Hence, it's better if investors wait in the short term.